Imagine a single, hidden indicator that quietly foreshadowed every major market crash and subsequent boom over the last 5 decades. It's not in the headlines, yet it's been consistently accurate, offering an edge few ever discover. Many of you likely felt the sting of 2008, watching your 401ks erode, or perhaps missed the explosive S and P 500 recovery post-pandemic. The constant cycle of fear and greed makes building generational wealth feel like guesswork. The dream isn't just to make money, but to keep it and grow it predictably. To know when to be aggressive in tech stocks and when to shelter your capital before the storm hits, protecting your financial freedom. But let's be honest, most predictors are just noise. Economic reports, analyst ratings, even earnings calls, they're often too late, reacting to what's already happened, not foreseeing the pivotal shifts that truly matter. We obsess over inflation, interest rates, company earnings, and GDP growth. Yet the biggest shifts in the S&P 500 often happen beneath the surface, driven by forces far more subtle than economic headlines suggest. There's smart money, the institutions, the hedge funds, the VCs, and then there's everyone else. These two forces move differently, often with opposing intentions, creating a critical divergence that reveals market truths. The data doesn't lie. Studies show over 80% of retail traders lose money over a 12-month period, underperforming even the simplest S&P 500 index fund. Why this consistent pattern of struggle? Because human psychology drives us to buy high and sell low, chasing the last big winner like GameStop, or missing the boat on Nvidia. This behavioral bias is precisely what smart money exploits. The real tell isn't just price, or volume, or even company news. It's something far more fundamental: capital flow. The silent, massive movement of billions between different assets and sectors, indicating true conviction. Think about it: who's actually buying? Who's selling? And where is that immense capital genuinely going next? This isn't about retail sentiment. It's tracking the institutional footprints, the true intentions of the market movers. This hidden capital flow indicator has consistently shown critical divergence months before every major market crash since the 1970s. From Black Monday to the dot-com bubble and the 2008 financial crisis. Take 2008, while the housing market peaked and headlines were optimistic. This indicator signaled a massive institutional exit from risk assets months before the Lehman Brothers collapse. A clear warning if you knew where to look. But it's not just about avoiding disaster. This same capital flow indicator whispers when the next boom is building, often in plain sight for those who understand its language, signaling massive opportunities. After the dot-com bust, while many were still reeling, this indicator showed a massive rotation of capital into commodities and real estate, fueling a decade of growth and creating new millionaires. It was the blueprint for the next wave. Understanding this isn't about complex algorithms or insider tips. It's about recognizing the footprints of smart money, the whispers of billions moving before the headlines scream. Stay with me, and I'll show you how to read them. To truly read those footprints, we must first understand the fuel that often ignites market exuberance: margin debt. And when investors borrow heavily to buy stocks, it's a powerful, yet fragile, force that historically precedes major market corrections. Consider the dot-com bubble. Margin debt peaked at 278 billion in March 2000, just as the S&P 500 began its 40% decline. Or 2008, where a similar surge preceded the GFC. It's not a coincidence, it's a behavioral pattern. The real danger isn't just borrowing, it's the cascade effect. When prices drop, margin calls force selling, creating a downward spiral. It's a vicious cycle where exuberance, fueled by debt, turns into panic, wiping out billions for those over-leveraged. The true signal isn't just the peak, but the asterisk rate of change asterisk in margin debt. A rapid contraction of, say, 15–20% within a quarter often signals institutions are deleveraging long before retail investors even consider selling. That's the smart money's early exit. But smart money isn't just about avoiding crashes, it's about positioning for the next boom. The indicator for growth isn't about leverage, but about asterisk institutional accumulation asterisk when large funds quietly build positions in undervalued assets. Long before the headlines scream buy. How do you spot this? It's not always obvious. Look for high volume on down days that don't lead to lower lows, or an increase in trading volume without a significant price surge. This suggests institutions are buying up shares without driving prices up immediately. Corporate buybacks are another powerful form of institutional accumulation. When companies repurchase their own shares, especially during market downturns, it signals confidence from the inside and often provides a floor for the stock price. Apple, for instance, has bought back over $600 million in shares since 2012. Then there's insider buying. When executives and directors of a company use their own capital to buy shares, especially after a dip, it's a powerful vote of confidence. They know their business better than anyone, and their actions often precede positive turns. The most potent crash signal emerges when a rapid contraction in margin debt converges, asterisk with significant institutional selling. This dual confirmation is like a flashing red light, indicating smart money is not just deleveraging, but actively liquidating positions. Conversely, the clearest signal for a market boom is a asterisk bottoming out asterisk of margin debt, coupled with sustained institutional accumulation. This indicates the market has been flushed. Weak hands are out, and smart money is quietly loading up for the next cycle of growth. Take 2009, post-GFC. Margin debt had plummeted, washing out speculative positions. Simultaneously, institutions like BlackRock and Vanguard were quietly deploying capital into distressed assets, setting the stage for one of the longest bull markets in history. This wasn't luck, it was calculated positioning. Even during the rapid COVID-19 crash in 2020, margin debt saw a sharp, albeit brief, contraction. But quickly, institutional buying emerged, particularly in tech and healthcare, leading to a swift V-shaped recovery. These signals, though accelerated, were still present. So, how do you integrate this? It's not about perfect market timing, but about risk management and strategic positioning. When margin debt spikes, consider reducing exposure to highly speculative assets. When it bottoms and institutions accumulate, look for undervalued opportunities. This demands discipline. When everyone is euphoric and margin debt is soaring, it's hard to pull back. When fear grips the market and smart money is quietly buying, it's even harder to invest. Your emotional control is your ultimate edge. Ultimately, this hidden indicator isn't a crystal ball, but a powerful lens. It helps you see beyond the noise, understand the true intentions of smart money, and position your portfolio for long-term wealth protection and growth, regardless of market headlines. But understanding this indicator is just the first step. True financial mastery comes from integrating it into a disciplined, long-term strategy, much like the most successful Silicon Valley founders who build generational wealth not just from IPOs, but from patient reinvestment. Even with the clearest signals, emotional biases like panic selling or chasing hype can derail a well-researched plan. Think of the 2020 crash, where millions sold at the bottom, missing the S&P 500s. Swift recovery and subsequent rally to new highs. The real game changer isn't perfect market timing, but consistent contributions to your 401k.
Or Oh, weak.
allowing compound interest to work its magic. A 25-year-old contributing just $300 monthly, earning 8% annually, could accumulate over $1.01 millions by retirement, far outperforming any short-term speculation. Your financial future isn't dictated by headlines or fleeting trends. It's shaped by your knowledge, your discipline, and your commitment to these proven principles. Take control, stay curious, and build the wealth that truly reflects your long-term vision.